Security Analysis by Benjamin Grham and David Dodd, an audiobook script. Chapter 1, The Investing Mindset. Value investing starts with a simple but powerful idea: every stock or bond has a real value underneath its market price. Benjamin Grham defined an investment as an operation which, upon thorough analysis, promises safety of principal and an adequate return. Anything lacking those qualities is mere speculation. In other words, good investors treat the stock market like a cautious partnership, always focusing on protecting capital and earning a fair return. The first step is to ignore the noise of daily prices and ask, what is this company really worth? This intrinsic value is based on fundamentals like its assets, earnings, and business prospects, not on what the crowd is paying today. Grham taught that market prices often swing wildly. Mr. Market can be euphoric or depressed for no good reason. A smart investor uses these swings as opportunities, not as predictions. By concentrating on facts, balance sheets, cash flows, competitive position, we can estimate a company's intrinsic value. If the stock trades well below that value, we have a margin of safety, a cushion against error and market downturns. Later chapters will show how to spot those bargains and calculate value, but the mindset is set: seek safety first, then returns. Chapter 2, Intrinsic Value and Margin of Safety. Every business generates value, but its market price may hide that fact. Intrinsic value is the investor's estimate of a company's true worth, rooted in assets, earnings, and future potential. When we say intrinsic value, think of it as the price you'd pay if you could buy the whole business. It might be higher or lower than today's stock price. Crucially, Grham and Dodd emphasize, intrinsic value is not a magic number but a range based on conservative assumptions. For example, a company's current assets, cash, inventory, receivables, plus the present value of future profits give clues to this underlying value. If market price intrinsic value, the difference is the margin of safety. This concept is the heart of value investing. As one writer explains, the margin of safety is the difference between the intrinsic value, fundamental value justified by facts, and the market value. In practice, if you determine a stock's intrinsic value is $100 per share but you can buy it for $70, that $30 difference, 30%, is your safety margin. It protects you if your estimate or the future proves wrong. Grham insisted on a large margin only buy when you're well below intrinsic value. This way, even if projections fail, you still have a buffer. Key Principles of Value Investing, a famous summary of Graham's ideas, lists several core points. Intrinsic value: every security has a real value justified by facts, its assets, earnings, dividends, and future prospects. Investors must try to estimate this true value. Margin of safety: a low purchase price relative to intrinsic value means a high margin of safety. Always buy below intrinsic value to cushion risks. Mr. Market: treat market prices as the moods of an irrational partner, sometimes greedy, sometimes fearful. Use these moods to buy low or sell high, not as gospel. Diversification: hold a broad range of stocks, Grham suggested at least 40, to reduce idiosyncratic risk. In summary, we know only approximate values. Margin of safety acknowledges uncertainty. One finance blog notes that Grham never gave a formula for it, he saw it as a judgment call. That means it's more art than science. The important rule is, don't overpay. Always leave room for error. Chapter 3, Security Types: Debt vs Equity. Before diving deep, let's review the kinds of securities Grham analyzed. The book separates them mainly into bonds, preferred stocks, and common stocks, because each has different risk and return features. Bonds: debts. A bond is a loan to a company, giving fixed interest payments and return of principal. Bondholders are creditors. They have the highest claim on company assets and earnings. As the Investopia Guide explains, bondholders are entitled to interest as well as repayment of the principal invested, and in a bankruptcy creditors are given legal priority over shareholders. In practice this means bonds are safer, stockholders often get nothing in a failure. Grham calls good bonds financial securities with a fixed value because their returns are defined and, ideally, safe. In valuation, bonds are judged by the safety of their interest payments and the likelihood of getting the principal back. Preferred stock, preferred shares sit between debt and common stock. Owners of preferred stock generally receive fixed dividend payments, like an interest on equity, and have priority over common shareholders. They usually do not have voting rights, but they get dividends first and have a higher claim on assets if a company liquidates. Preferreds are treated partly like debt. Grham often values them by looking at their dividend and safe asset base, but they have no maturity date. Thus, they carry more risk than bonds but less than common stock. Common stock, equity. When you buy common stock, you own a piece of the company. You are entitled to share in profits, via dividends or retained earnings, and vote in major decisions. Stocks are the riskiest security because shareholders are last in line at bankruptcy. However, they also offer the greatest upside. If the business thrives, stock value can soar. Grham and Dodd stress that analyzing common stock means understanding the business itself, its earnings power, dividend policy, growth prospects, and management quality. Unlike bonds and preferreds, common stocks have no fixed payments. Their value comes solely from the underlying company's performance. Each security type requires its own analysis. For bonds and preferreds, focus on asset backing and ability to pay interest or dividends. For common stocks, focus on future earnings and the strength of the enterprise. The classic book will spend many chapters on common stock analysis, but it always starts with the simpler valuations of debt and preferreds, which act as a safety net. If a company's assets safely cover its obligations, common shares inherit a strong backing. Chapter 4, Balance Sheet Analysis. Safety first. Value investors start with the balance sheet, the snapshot of a company's resources and obligations. As Investopedia notes, for investors, the balance sheet is an important financial statement showing assets owned versus liabilities owed at a given date. A strong balance sheet means more assets relative to debt, giving a margin of safety. A worrisome balance sheet has heavy debt or intangible claims, which raises risk. Grham taught to focus on tangible assets and conservative values. For example, companies often have goodwill or intangibles that are hard to value. If a balance sheet has lots of water, inflated asset values, one must mark them down. In Graham's era, he famously used tax disclosures to estimate how much of a company's reported assets were real versus hidden goodwill. Today, an analyst might discount intangible items or require extra margin if goodwill is large. A quick check: is the company owning enough hard stuff, cash, inventory, machinery, real estate, to back its market value? If not, buyer beware. Modern balance sheets vary in format, but Graham's principle holds: assets liabilities equals net worth. Investors often compute book value per share, total equity divided by shares outstanding, to see if a stock price is trading at or below net worth. If a stock sells below book value, it may hide a margin of safety. However, Grham warned that book value isn't everything. The quality of those assets matters. Key measurements on the balance sheet. Cash and liquid assets. Ample cash and short-term investments make the company safer. They provide a buffer in hard times. Current liabilities vs current assets. Working capital. Ideally, current assets, cash, receivables, inventory, far exceed current debts, bills due. This working capital cushion protects against short-term trouble. Long-term debt. High debt loads make a balance sheet fragile. Grham liked companies that could pay off debt from a single year's earnings or that had very little debt at all. One should be skeptical if liabilities far exceed tangible equity. For example, Investopedia points out that a balance sheet might be unappealing if its debt liabilities are seriously in excess of its tangible equity position. In other words, too much debt relative to real assets is a red flag. Value investors may avoid or heavily discount such cases. Ultimately, the balance sheet tells us, if the company were liquidated today, how much would an owner get? This ties back to intrinsic value. Grham often compared liquidation value, net of liabilities, to market price. A large gap meant safety. But he cautioned that some businesses might earn much more alive than dead, so sometimes book value undervalues franchise strength. Thus, balance sheet analysis protects downside, while deeper analysis explores upside. Chapter 5, Earnings and Earnings Power. Once the balance sheet passes the sniff test, an analyst studies the income side. The earnings power of a business, its ability to generate cash over time, is central to intrinsic value. Grham didn't just look at reported net income, which can be distorted by accounting. He focused on owner's earnings, the true cash that a company can pay out after necessary expenses and maintenance investment. As one passage explains, Dodd referred to that excess cash as earnings power or owner earnings. That's the amount of cash an owner can pocket after paying all expenses and making whatever investments are necessary to maintain the business. This free cash flow is the well from which all returns are drawn, whether they are dividends, stock buybacks, or investments capable of enhancing future returns. In plain terms, owner's earnings equals net income plus non-cash charges, depreciation, amortization, minus maintenance capital expenditures. It excludes growth capex so we don't overstate how much cash is truly available for investors. Grham and Dodd treated this owner's earnings as the baseline for valuing common stock. They would estimate a company's sustainable annual owner's earnings and then multiply by a conservative factor to gauge intrinsic value. For example, if a company can comfortably earn $5 of owner's earnings per share each year, and the business is stable, no rapid industry decline, an investor might consider paying, say, $50 per share, implying a 10 times multiple, especially if the stock is priced below that, giving a 10% expected yield. But if the firm's business is cyclical or uncertain, a higher margin, lower price, is required. Grham warned that earnings can be volatile. He favored businesses with stable, predictable profits. When analyzing earnings, pay attention to accounting quality, watch for aggressive accounting. If profits jump due to one-time gains or creative accounting, skip or adjust. Business cycles, average earnings over a cycle. Don't base value on a single good year. Usually, Grham averaged 5 to 7 years of earnings to smooth out peaks and troughs. Hidden buffers, sometimes companies have off-books items or hidden assets, like undeclared investments or undervalued subsidiaries. Thorough analysis might uncover these and increase intrinsic value. In security analysis, Grham and Dodd stress that the ultimate determinant of value is a company's capacity to earn profits over time. Everything hinges on this earning power. As 30 notes, this free cash flow is the well from which all returns are drawn. Dividends, stock repurchases and retained earnings all flow from it. Hence, estimating realistic earnings power is critical in any intrinsic value calculation. Chapter 6, Common Stock Valuing the Business. With balance sheets and earnings power in hand, we turn to common stock analysis. Here Grham and Dodd shine in detailing how to think like business owners. The goal is to estimate what the whole company is worth based on its ability to generate profits in the future. Several methods and considerations come into play. Dividend discount/earnings multiples. One approach is to treat the stock like a bond or annuity, valuing it by dividends or sustainable earnings. For example, if a company pays $2 in dividend per share and you require an 8% yield, a fair price is $25. If the market price is $18, you have a margin of safety. For companies that don't pay dividends, Grham would use earnings instead. Suppose owner's earnings are $5 per share and he uses a capitalization rate of 10%, i.e. 10 times multiplier. That suggests an intrinsic value of $50. Asset-based vs earnings-based. If a company's earnings are uncertain, analysts might use adjusted book value. That means adjusting assets to realistic values, e.g. write down overvalued intangibles or inflate liquidation values, and then adding a premium for earning capability. Often Grham combined both methods, start with net asset value and then see how much extra can be justified by earnings. Industry and competitive position. Beyond numbers, consider whether the company has competitive advantages, brands, monopolies, economies of scale. A strong moat can justify paying more, smaller margin, while a commoditized business demands a larger margin of safety. Remember Warren Buffett's evolution. He later paid less emphasis on margin and more on quality of businesses, but Graham's classic view errs on the side of caution. Earnings growth. Modest growth can tilt intrinsic value higher. If a company consistently reinvests and grows earnings, the valuation model incorporates expected growth. However, avoid aggressive projections. Grham preferred to focus on current or normalized earnings and dividends unless there is clear reason to believe in sustainable growth. Conservatism. When in doubt, be conservative. Use low growth estimates, demand big margins, and favor companies with record profits. Grham often said that great performance doesn't necessarily lead to great stock prices if the price already reflects that performance. Instead, seek fat pitch deals, solid companies priced cheaply. Through chapter after chapter, Security Analysis walks through examples, utility stocks, railroad shares, industrials, and more. Each example reinforces the core: buy a stock when price per share, intrinsic value per share, with a cushion. And remember, intrinsic value for a common stock is essentially the present value of future earnings after all obligations, debt, preferred dividends, are met. Chapter 7, Preferred Stock and Other Issues. Preferred stocks, though simpler than common, have their own twists. Recall they pay fixed dividends and rank above common equity. Grham generally treated preferreds as conservative equities or as debt with peculiar terms. Key points for preferreds. Dividend coverage. Just as with bonds, check if earnings comfortably cover the preferred dividend. A large buffer means safety, a thin one means risk. Grham liked preferreds where coverage was several times the dividend, similar to bond interest coverage ratios. Asset backing. Ideally, preferreds are backed by substantial assets. For example, if the PAR value of preferred is $100 and the company has net assets worth much more per share, preferred owners have margin. Sometimes Grham found situations where the sum of bond and preferred claims was way less than total assets, a boon for investors. Callable feature. Many preferred shares are callable, company can redeem at certain price. This adds reinvestment risk, dividend yield might plummet when called. Grham adjusted valuations accordingly, either treat call price as a cap on value or demand higher yield. Convertibles and hybrids. Some securities straddle debt and equity, convertible bonds, participating preferreds. Graham's method: separate them into bond part and equity part. Value the bond element by interest and asset claims, value the equity option, e.g., conversion feature, by conservative estimates of future stock price. Although often overlooked today, preferred stocks were more common in Graham's time. The lessons carry on. Even in modern terms, think of preferreds as quasi-debt. If you can buy a preferred yielding 6% on a solid asset base, that's better safety than a random 4% yield stock with no guarantee. Chapter 8, The Role of Dividends. Dividends are the real cash rewards for common shareholders, so they factor heavily in security analysis. Grham and Dodd viewed dividends as concrete evidence of profitability. A long history of steady or growing dividends signals a healthy business. Conversely, irregular or zero dividends warrant caution. Dividend policy: some companies reinvest all profits. That's fine if reinvestment yields high returns. But lack of dividends requires the analyst to trust management's reinvestment skill. Grham was wary of firms without dividends unless they showed extraordinary growth metrics. Payout ratio and retention. A stable payout ratio, dividends as percent of earnings, suggests earnings reliability. If a company suddenly slashes its dividend, that can signal trouble. Grham would often value a stock by assuming dividends remain stable or grow modestly at a similar rate as earnings. Accumulated retained earnings. Over time, reinvested earnings should build book value, assets, or fuel growth. If a company claims large retained earnings but never pays dividends or shows growth, Grham would suspect that these earnings were illusory, maybe eaten by dilution or accounting gimmicks. Importantly, Grham stressed that dividend-paying capacity is part of intrinsic value. One could think of intrinsic value as the capitalized value of future dividends, plus any end liquidation value. This viewpoint ties back to owner's earnings. If a business can sustain $X in dividends every year, what multiple is justified? That multiple depends on stability. Safer, regulated, utility-like businesses might justify high multiples. Low yield, risky businesses must trade at low multiples. In summary, dividend policy and history is a crucial check on the earnings analysis. A company that dutifully paid shareholders through thick and thin is likely more reliable. It also means shareholders see real cash, not just promises. Grham often discounted stocks that were all growth, no yield unless there was overwhelming evidence of future profit. Chapter 9, Market Fluctuations and Mr. Market. Graham's colorful analogy of Mr. Market deserves its own discussion. Imagine a partner named Mr. Market who shows up every day offering to buy your stake or sell you more stock at a price he quotes, but his mood swings wildly. Some days he's euphoric and offers huge prices, overvalued. Some days he's panic-stricken and offers rock-bottom prices. The intelligent investor treats Mr. Market as helpful but erratic. When Mr. Market's price is high, above your estimate of intrinsic value, you politely refuse to sell. He's overpaying. When his price is low, below intrinsic, you seize the chance to buy. This metaphor teaches emotional discipline. Market prices don't always reflect true value, so use them as opportunities. In practice, this means sticking to fundamentals regardless of market hype or panic. Security analysis predates the formal efficient market theory, but it essentially advocates a semi-strong inefficiency. The market is often wrong, not right. It's up to the investor to do independent analysis. Buffett, Graham's student, later cited this idea as crucial to value investing. Another psychological aspect, the book emphasizes patience. Value opportunities often arise in recessions or bear markets. Good companies go out of favor due to short-term fears exactly when rational investors should start buying. Conversely, in bubbles the book warns to expect losses. Grham famously lamented that most investors mistake effort and activity for true analysis. A disciplined approach might mean waiting a long time for prices to align with intrinsic values. Finally, Grham advocated diversification not just as risk management, but also as a psychological tool. By owning many different companies, he suggested 40+, you reduce the impact if any one story turns out poorly. It smooths out the emotional roller coaster, because no single stock's mood swing can make or break your portfolio. Chapter 10, Putting it all together. Having covered the core ideas, how would a value investor use them in practice? Security analysis essentially advises a multi-step process. 1. Select quality businesses. Prefer companies with steady earnings, strong balance sheets and long histories. Grham called these enterprising or defensive securities depending on the investor's approach. 2. Analyze the balance sheet. Confirm that assets justify at least a portion of the stock price. Look for understated asset values or overlooked investments. 3. Assess earnings power. Calculate normalized earnings or owner's earnings over several years. Be conservative, adjust for one-time items, cyclical peaks, or volatile income. 4. Estimate intrinsic value, using the earnings power and maybe dividend yields, compute a value. For example, capitalizing earnings at a low rate, high multiple, if stable, or a higher rate if uncertain. Another approach, sum up adjusted assets plus a reasonable multiple of earnings beyond depreciation. 5. Compare to market price, only if the market price is substantially below your intrinsic value estimate do you proceed. For a margin of safety, Grham liked discounts of 30–50% for average businesses, even bigger for riskier ones. 6. Diversify, buy a basket of such undervalued issues to protect against individual errors. Keep positions reasonably sized so that one failure won't ruin you. 7. Monitor and reevaluate, if a stock reaches or exceeds intrinsic value, or if the business deteriorates, be ready to sell or reduce the position. Likewise, if intrinsic value changes, e.g. due to new information, recalculate. Throughout this process, avoid technical jargon unless needed. Explain each idea simply. For example, when we say intrinsic value, we might say it's like the true worth of a share, calculated from real numbers. When we speak of margin of safety, we can liken it to the extra seatbelt or the cushion that protects an investment from shocks. Value investing principles distilled from security analysis are straightforward but require discipline. Buy cheap stocks of good companies. It may not sound glamorous, but as Grham and Dodd's work shows, this approach is powerful over the long term. It's about capital preservation first and letting the gains follow from sound decisions. In closing, remember these guiding thoughts. Invest only when there is a margin of safety. This means buying at a big discount to intrinsic value. Focus on business value, not the ticker. Price is what you pay, value is what you get. It's the business's assets and earnings that matter. Patience and discipline trump hunches. Let the market's ups and downs work for you, not against you, Mr. Market. Diversify to limit risk. Even great analysis can fail, a broad portfolio smooths out surprises. Security analysis may have been written in the 1930s, but its lessons are evergreen. Its core message is simple: thorough analysis plus conservative valuation equals successful investing. By following Grham and Dodd's principles, treating stocks as pieces of real businesses and insisting on a margin of safety, an investor puts the odds in their favor. Sources: Grham and Dodd's Classic Security Analysis, 1934, various editions, and Commentary on Value Investing. The concepts here are explained in plain English for clarity and audio narration.